In today's video, we are doing a deep dive into mining business accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Mining businesses, like Vedanta Resources, involve extracting valuable minerals from the earth. This global industry is crucial for metals such as copper, zinc, and aluminum. Major players include Rio Tinto, BHP, and Glencore. In India, companies like Vedanta dominate due to rich mineral reserves. The mining sector powers industries worldwide, making it essential for economic growth and infrastructure development. Mining companies make money by extracting and selling minerals. Vedanta's revenue streams include selling metals to automotive and electronics industries. Major costs involve equipment, labor, and regulatory compliance. Companies focus on efficient extraction and cost management to remain profitable. Understanding these dynamics helps explain their financials and strategic decisions. In mining, departments like finance, operations, procurement, and legal play crucial roles. Finance handles budgeting and reporting, crucial for forecasting. Operations manage extraction processes, ensuring efficiency. Procurement sources equipment, affecting cost control. Legal navigates complex regulations. Each department's role influences accounting, showing how integrated efforts maintain operational and financial health. Understanding the workflow in mining helps in grasping accounting intricacies. It starts from exploration, where potential sites are evaluated. Then extraction processes commence, followed by mineral processing to refine raw materials. The logistics stage involves transporting products to clients, and finally, sales complete the cycle. Each phase has accounting implications, from cost recording to revenue recognition. Stakeholders in mining include clients, vendors, government, banks, and regulators. Clients purchase minerals affecting sales records. Vendors supply machinery, impacting procurement costs. Governments and regulators impose taxes and compliance costs. Banks provide financing, affecting interest and debt accounts. Understanding these relationships highlights how stakeholder interactions influence financial and operational aspects. Mining faces challenges like a complex working capital cycle, contract intricacies, and strict regulatory requirements. Long extraction and production cycles delay cash inflows, affecting liquidity. Complex contracts require meticulous accounting to track obligations and revenue. Regulatory compliance is costly but essential to avoid fines. Understanding these challenges highlights the need for detailed financial management in mining. Accounting in mining is unique due to asset-heavy operations, environmental liabilities, and fluctuating commodity prices. Asset management is crucial due to extensive use of machinery. Environmental liabilities require provisions for future restoration costs. Commodity price volatility affects revenue projections and requires dynamic pricing strategies. Understanding these factors highlights why mining accounting requires specialized knowledge and detailed tracking. In mining, accounting entries are typically passed by the finance team. Triggers include transactions like sales, purchase orders, and cost allocations. Accurate entries are vital for financial reporting and compliance. The finance team collaborates with operations to ensure data accuracy. Understanding this process shows how accounting supports strategic decision-making and operational efficiency. This section will guide you through each detailed step of the accounting lifecycle in a mining company like Vedanta Resources. From initial requisitions to the final reconciliation, we break down the complex journey into understandable steps. Understanding these processes ensures effective financial management and compliance with industry standards. This knowledge is crucial for both operational efficiency and strategic decision-making. In mining, the process begins with tender or order requisition. This involves identifying the need for materials or services crucial for mining operations. The procurement department, using systems like SAP, handles this step. Accurate requisition helps prevent operational delays and cost overruns. Errors here, such as incorrect item specifications, can lead to project holdups and financial discrepancies. A clear requisition ensures streamlined procurement and effective budgeting. Once requisitions are approved, contracts or purchase orders, POs, are created. The finance team ensures budget alignment, and legal teams check compliance with regulations and standards. This step is vital for securing fair pricing and managing legal risks. Errors in POs, like incorrect terms, can lead to financial loss or legal issues. Properly executed contracts protect against disputes and ensure procurement aligns with the business strategy. Advance payments may be required for certain procurement. The finance department processes these payments to secure supplier commitment. Goods receipt involves verifying quality and quantity against the PO. This step uses inventory management systems and involves both warehouse and finance teams. Inaccurate records or quality issues can cause inventory discrepancies and financial losses. A thorough receipt process ensures accurate inventory levels and supports cost control. In mining, work in progress represents ongoing production costs. Accounting for WIP is crucial to tracking project profitability and resource utilization. This involves continuous monitoring by project management and accounting teams. Accurate tracking helps in identifying cost variances early. Errors, such as overlooked costs, lead to skewed financial statements and strategic misalignment. Proper WIP accounting provides insights into project efficiency and budget adherence. Upon project completion, invoicing is initiated. The finance department prepares invoices based on agreed contract terms. Accurate invoicing ensures timely payments and maintains cash flow. Errors, like incorrect billing amounts, can delay payments and damage supplier relationships. Proper payment processing involves verifying invoice accuracy and aligning with cash management strategies. Efficient invoicing and payment processes are vital for financial health and supplier trust. Reconciliation involves matching financial records with bank statements to ensure accuracy. This step, managed by the accounting department, helps identify discrepancies early. Errors in reconciliation can lead to misstated financial statements and audit issues. Period close finalizes accounts for a specific period, providing a basis for financial reporting and analysis. Accurate reconciliation and timely period close are critical for transparency and informed decision-making. This flow diagram visualizes the mining accounting process. It highlights key stages from tender requisition to period close. Understanding this flow is essential for grasping the interconnectedness of each step and its impact on overall financial operations. Effective flow management ensures seamless operations, minimizes errors, and enhances strategic planning. Use this diagram to reinforce your understanding of the sequence and dependencies within the mining accounting lifecycle. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples in real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition is crucial in accounting as it dictates when a company should record revenue in its financial statements. This concept is particularly important in the mining industry due to the prevalence of long-term contracts and the volatile nature of commodity prices. Indian Accounting Standard 115 and International Financial Reporting Standards 15 provide guidance on this, requiring companies to identify contracts, determine performance obligations, and recognize revenue as these obligations are satisfied. For instance, a mining company like Vedanta Resources must recognize revenue when it transfers control of extracted minerals to the customer, not just when they are mined. Unlike general accounting, mining must consider contract specifics and global price fluctuations to ensure accurate revenue reporting. Inventory valuation is the process of attributing a monetary value to unsold goods, a significant concern for mining companies like Vedanta Resources, which have inventories at various stages of mineral extraction. This is governed by Indian Accounting Standard 2 and IAS 2, which offer methods such as FIFO, first in, first out, LIFO, last in, first out, and weighted average to calculate costs. For instance, a mining company must consider the stage of processing and market conditions when valuing extracted ore. Unlike general businesses, mining inventories can include raw, in-process or refined materials, demanding precise valuation to reflect true financial health. Fixed assets and depreciation involve tracking and expensing the cost of long-term assets over their useful lives. In mining, this is vital due to significant investments in machinery, buildings, and land improvements. Indian Accounting Standard 16 and IAS 16 govern this area, dictating the systematic allocation of an asset's cost over its useful life, based on usage or time. For example, a mining truck's cost is depreciated based on its expected operational lifespan. Unlike general accounting, mining requires careful assessment of asset life due to intense usage and harsh operating conditions, impacting depreciation schedules and financial results. Lease accounting addresses how companies record leased assets and related obligations, a common practice in mining for equipment and land. Indian Accounting Standard 116 and International Financial Reporting Standard 16 govern this, requiring leases to be capitalized on the balance sheet, recognizing both an asset and a liability. This ensures transparency in financial statements by acknowledging the true extent of a company's obligations. For a mining company like Vedanta Resources, capitalizing leases of heavy machinery affects asset and liability reporting, differing from general accounting where smaller leases may not significantly impact the balance sheet. Provisions and contingencies deal with estimating and recognizing potential future liabilities, an essential aspect in mining due to environmental and site rehabilitation obligations. Indian Accounting Standard 37 and IAS 37 guide this practice, requiring companies to recognize liabilities when they are probable and can be reliably measured. For example, after mining operations, companies like Vedanta Resources often have obligations to restore mining sites, creating provisions for future costs. This differs from general accounting, as mining faces unique environmental challenges that demand specific provisions, impacting financial statements significantly. Foreign currency transactions involve accounting for operations conducted in currencies different from the entity's functional currency, particularly relevant in mining due to its global market involvement. Indian Accounting Standard 21 and IAS 21 regulate this, emphasizing the importance of translating foreign currency transactions into the functional currency at the date of the transaction. For a company like Vedanta Resources, dealing in multiple currencies requires careful conversion and reporting to reflect true financial performance. Unlike general industries, mining must frequently adjust for exchange rate fluctuations, affecting profitability and financial metrics. Cost allocation involves distributing indirect costs to products or services, a necessity in mining for apportioning exploration, production, and administrative costs. While not governed by a specific accounting standard, cost accounting principles guide this process, emphasizing fair allocation based on benefits received. In mining, companies like Vedanta Resources must allocate costs of shared resources, such as electricity or administrative expenses, accurately to different mining projects. This differs from general accounting due to the complexity and scale of mining operations, necessitating detailed and precise cost distribution. Segment reporting entails disclosing financial information by separate business segments, crucial in mining due to operations across various locations or types of minerals. Indian Accounting Standard 108 and International Financial Reporting Standards 8 guide this, requiring companies to report segment-specific profit, assets, and liabilities. For example, Vedanta Resources might disclose separate financials for its copper, zinc, and iron ore divisions, providing stakeholders with insights into different operational areas. Unlike general accounting, mining companies benefit from segment reporting to highlight performance across diverse resource types and geographical locations, aiding strategic decision-making. Financial instruments encompass contracts like derivatives, crucial for mining companies to hedge against commodity price volatility. Indian Accounting Standard 109 and International Financial Reporting Standards 9 govern these, focusing on the classification, measurement, and recognition of such instruments. For instance, Vedanta Resources might use futures contracts to lock in prices for metals, reducing exposure to market fluctuations. This differs from general accounting, as mining companies often engage in complex financial arrangements to stabilize earnings amidst the inherent unpredictability of global commodity markets, ensuring financial stability and accurate reporting. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. The initial capital injection is crucial for starting any business. Here, Vedanta Resources received 10 crore rupees from investors, which is credited to share capital, representing ownership equity. The bank account is debited because it increases the company's cash resources, enabling operational and capital expenditures. This entry establishes the initial funding for Vedanta to commence its mining operations. The purchase of mining equipment is a capital expenditure, which is recorded as an asset in the property, plant, and equipment account. This investment is vital for operational capacity and efficiency. The debit entry reflects an increase in assets, while the bank account credit indicates a cash outflow. By acquiring machinery, Vedanta is better positioned to extract minerals, leading to potential future revenue. Raw materials are essential for mining operations, representing the initial input in the production process. The inventory account is debited, signifying an increase in resources available for production. Meanwhile, accounts payable is credited, reflecting a liability since the purchase is on credit. This setup allows Vedanta to continue operations without immediate cash outlay, maintaining liquidity for other expenses. The initiation of mining operations involves various costs, such as labor, fuel, and maintenance. These are recorded under work in progress, representing ongoing production activities. The debit entry signifies an increase in assets earmarked for future revenue generation. The bank account is credited, indicating cash outflows. Efficient management of these costs is critical for maintaining profitability and ensuring smooth operations. Sales of minerals mark the transition from production to revenue generation. By crediting revenue, Vedanta reflects earned income, a key performance indicator. The accounts receivable debit entry indicates future cash inflows. This credit sales arrangement allows the company to expand market reach by accommodating customer payment capabilities, crucial for fostering long-term business relationships and consistent cash flow. Collecting receivables transforms credit sales into tangible cash, critical for maintaining liquidity. The bank account is debited, indicating an increase in cash resources, while accounts receivable is credited, reflecting a decrease in outstanding customer obligations. This flow of cash is crucial for covering operational costs, repaying debts, and potentially reinvesting in business growth and expansion. Paying suppliers is crucial for maintaining strong business relationships and ensuring a steady supply chain. The accounts payable debit entry reduces liabilities, while the bank account credit reflects cash outflow. Timely payments support supplier trust and can lead to favorable credit terms. This enhances operational efficiency and ensures continuous material flow for ongoing production activities. Depreciation reflects the wear and tear of assets over time, impacting financial statements by reducing taxable income. By debiting depreciation expense, Vedanta acknowledges this cost, while crediting accumulated depreciation maintains an ongoing record of asset value decline. Recognizing depreciation helps accurately assess asset value, ensuring proper financial planning and asset replacement strategies. Year-end closing entries transfer temporary account balances to the profit and loss account, marking the end of the fiscal period. By closing revenue, Vedanta captures total income, while closing expenses reflects the operational costs. These entries summarize the year's financial performance, providing insights into profitability and guiding management decisions for future strategic planning and resource allocation. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In mining, current assets like cash and inventory are crucial for daily operations. Cash ensures liquidity, while inventory represents unsold mined materials. Increases in accounts payable reflect delayed payments to suppliers, impacting cash flow but retaining liquidity. Short-term debt might be used to finance immediate needs, keeping operations smooth. Understanding these elements helps predict cash needs and manage operational efficiency, critical in fluctuating markets like mining. In mining, non-current assets like property, plant, and equipment are significant due to the capital-intensive nature of the industry. They represent substantial long-term investments. Intangible assets might include mining rights or patents. Equity increases through retained earnings and share capital, reflecting profits reinvested or capital raised. These elements provide insights into the company's long-term stability and growth potential, which are vital for stakeholders assessing the company's future prospects. For mining companies, sales revenue represents the income from selling extracted materials. It's crucial for measuring business performance. Cost of goods sold includes expenses directly linked to production, such as labor and materials. Gross profit, calculated as revenue minus cost of goods sold, indicates the efficiency of production processes. By analyzing these figures, stakeholders can assess the profitability of mining operations and identify areas for cost optimization, ensuring long-term competitiveness. Mining companies incur operating expenses such as administrative and marketing costs, impacting net profitability. EBITDA, a non-generally accepted accounting principles measure, highlights operational performance, excluding non-operating factors like interest and tax. Profit before tax, accounts for these factors, providing a pre-tax profitability measure. Understanding these metrics helps stakeholders evaluate the company's operational efficiency and financial health, guiding strategic decisions and providing insights into potential tax implications and financial structuring. Cash flow statements in mining detail the liquidity impact of operations, investments, and financing. Operating activities reveal cash generated from core operations, essential for sustainability. Investing activities typically show large outflows as companies invest in equipment and exploration, crucial for future growth. Financing activities illustrate how operations are funded, through debt or equity. Analyzing these provides a comprehensive view of financial health, guiding decisions on cash management and investment priorities. Key financial ratios offer insights into a mining company's performance. The current ratio evaluates liquidity, crucial for operational stability. The debt-to-equity ratio indicates financial leverage, reflecting risk and financing strategy. Return on assets assesses how effectively assets generate profit, an important efficiency measure. Net profit margin reveals overall profitability, guiding pricing and operational strategies. Together, these ratios help stakeholders make informed decisions about investment, risk management, and strategic planning. In this section, we will go through all the key concepts of common errors in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Misstating audit findings often arises when there's a breakdown in communication between auditors and management. This can lead to significant discrepancies in reported financial health, affecting investor confidence. Correct treatment requires detailed audits and transparent communication channels. An auditor would detect this through inconsistencies in documentation and by comparing previous audit reports. For instance, in a mining company like Vedanta Resources, incorrect reporting on asset depreciation or liability provisions could skew profitability analyses. Interview traps are common pitfalls where candidates may not fully understand or answer complex industry-specific questions effectively. In mining accounting, this might involve detailed queries on asset valuation or environmental liabilities. These errors occur due to inadequate preparation or misunderstanding industry practices. Correcting this involves comprehensive study of industry standards and trends, enhancing the chance of successful interviews. Employers, such as those at Vedanta Resources, value candidates who can demonstrate nuanced understanding, reflected in their strategic decisions and financial reporting. ERP system configuration errors can significantly disrupt financial reporting by causing transaction misstatements. Such errors typically arise from incorrect initial setup or system updates that aren't properly managed. For a mining company like Vedanta Resources, this might result in incorrect inventory valuations or misallocation of production costs. Correct treatment involves ensuring that ERP systems are well configured and regularly audited to match the operational needs of the company. Auditors would look for discrepancies in transaction flow and validate system settings against actual business processes. Cutoff errors in revenue recognition occur when transactions are recorded in the wrong accounting period, often due to timing issues. For example, if Vedanta Resources records revenue from a mineral sale before the delivery is completed, it misrepresents the actual financial period's performance. Correct accounting treatment involves recognizing revenue only when control of goods transfers to the customer, ensuring compliance with accrual accounting principles. Auditors detect such errors by reviewing shipment dates in contrast to revenue entries, ensuring consistency and accuracy. Standard switching errors arise when a company inconsistently applies accounting standards across different periods, causing comparability issues in financial reports. This can happen if Vedanta Resources switches between international financial reporting standards and local generally accepted accounting principles without proper justification or disclosure, misleading stakeholders. Correct treatment involves clearly documenting the reasons for any changes and ensuring consistency unless a valid change in accounting policy is needed. Auditors detect these errors by reviewing the consistency of accounting policies over time and ensuring proper disclosures are made in the financial statements. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Depreciation allocates the cost of an asset over its useful life. Straight-line depreciation spreads the cost evenly, useful for assets like office buildings. Reducing balance charges more depreciation initially, suiting assets like mining equipment that lose value quickly. For example, Vedanta Resources might use straight-line for its headquarters, while the reducing balance for heavy machinery, reflecting actual wear and tear. When disposing of a mining truck, debit accumulated depreciation to remove it from the books, credit the asset account to remove its cost, and record any gain or loss. If Vedanta Resources sells the truck for more than its book value, record a gain. This entry ensures accurate asset valuation and reflects the transaction's financial impact on the balance sheet. International Financial Reporting Standards 6 allows mining companies to defer exploration costs until the feasibility of extraction is determined. This means Vedanta Resources can capitalize costs like drilling and surveys, providing financial flexibility. The standard encourages transparent reporting, ensuring investors understand the financial health of projects. If a project is deemed unviable, costs must be written off, impacting profit and loss statements. Reclamation costs are estimated liabilities for restoring mining sites post-extraction. Vedanta Resources must recognize a provision when the obligation arises, usually when mining begins. Costs are capitalized as part of the asset and expensed over its life. This ensures future financial impacts, like regulatory compliance, are accounted for, reflecting the true cost of mining operations. SAP ERP integrates financial data across Vedanta Resources, enhancing decision-making through real-time insights. It streamlines processes like asset management and cost tracking, crucial for complex mining operations. Automation reduces errors and improves efficiency, allowing the company to monitor budgets, forecast trends, and comply with regulations. SAP's adaptability ensures it meets industry-specific needs, supporting dynamic business environments. Under International Financial Reporting Standards 15, revenue is recognized when control of goods transfers to the customer. For Vedanta Resources, this could be when ore is delivered. The five-step model involves identifying contracts, performance obligations, transaction prices, allocations, and satisfaction. This ensures revenue accurately reflects economic activity, providing stakeholders confidence in financial statements and supporting strategic business decisions. Transfer pricing in mining involves pricing transactions between subsidiaries. Challenges include determining arm's-length prices for unique commodities like Vedanta Resources metals. Regulatory scrutiny is high due to potential tax base erosion. Accurate pricing is crucial to comply with laws and avoid penalties. It requires thorough documentation and analysis of market conditions and internal processes to ensure transparency and fairness. Impairment testing assesses whether a mining asset's carrying amount exceeds its recoverable amount. Vedanta Resources must evaluate at least annually, comparing net book value with expected future cash flows, or fair value. If impaired, record a loss to reflect decreased asset value. This ensures accurate financial reporting, informs investors, and aligns with regulatory requirements. Regular testing mitigates risk by identifying underperforming assets early. Classifying exploration costs as an asset can inflate financial positions, as costs are capitalized rather than expensed. For Vedanta resources, this could mislead stakeholders about profitability if projects turn unviable. Critics argue it defers recognition of economic realities, causing volatility. Proper classification ensures accurate reflection of current financial health and risk exposure, maintaining investor confidence and aligning with prudence principles. In mining, the business model begins with exploration to identify potential mineral sites using geological data. Once a deposit is located, companies like Vedanta Resources extract the ore through controlled blasting or other methods. The extracted material undergoes processing to separate valuable minerals, followed by refinement to increase purity levels essential for industrial use. Transportation then ensures these products reach global markets, leading to sales revenue, primarily from industries requiring raw materials like copper or aluminum. Accounting in the mining sector involves understanding revenue recognition, where control of goods dictates when revenue is booked. Cost of sales includes direct costs incurred in mining and processing. Exploration costs may be capitalized if they promise future benefits. Assets are depreciated over time using appropriate methods, reflecting their usage. Inventory is valued conservatively at the lower of cost or net realizable value. Environmental liabilities are crucial, as they account for future restoration obligations incurred during operations. Preparing for a mining business accounting interview involves various key areas. Stay updated on industry trends, particularly shifts in mineral demand and pricing. Understand the impact of environmental regulations on operations. Showcase technical skills in accounting software, crucial for handling complex financial data. Demonstrate your ability to analyze financial statements for insights into a company's performance. Discuss ethical considerations, focusing on sustainability. Finally, provide operational insights that could lead to efficiency improvements in mining processes. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to Candy Mentor for more finance and accounting videos.